Let me start with a scene you probably know. It's morning, you are open your phone, and in less than 30 seconds, you see three completely different realities. Markets, as we know very well, are booming, recession is coming, this new technology, all right, will change everything. If you ever close the app and thought, okay, so what I'm supposed to do with my money, you're not alone. The episode is my answer today. I'm going to share with you how I'm thinking about this year using simple language, real numbers, and a calm mindset, of course, as always. No complex jargon, no hot takes, just a clean way to stay rational when the words get loud. This is not personal financial advice, of course. It is my framework, so you can build yours if you want. And I think we can just beginning with this fantastic episode. So, how I'm investing into the 2026 when the noise gets loud. Good morning, everyone. I am Alessandro. I am the founder of Macro Mornings. We are more than 53,000 investors worldwide. We are the top 1% of investing newsletter out there where I share my insights and my strategies to help you understand the markets before anyone else. You can find the link in the description to subscribe totally free today and join us. So I just remember 2025 was one of those years that can mess with your expectations in a good way and in a dangerous way. The S&P finished the year up about 16% in price terms, of course, and roughly 18% including dividends. It also hits 38 record highs. That's the kind of the year that makes you feel smarter, even if you did nothing. And bonds surprised too. The broad US market returned about 7%, its strongest year since 2020. So we entered this year, the 26, with momentum. But when you come off a year like the last year, so the 2025, it's easy to expect the same again. Yet we've already had unusually strong run. Stocks have delivered more than 15% gains in 6 of the last 7 years. That's not the long-term average experience of investors. So when strategies say this year may be more muted, I don't hear pessimism. I hear realism. I'm not preparing for a disaster. I'm preparing for a year where returns may be positive, but less flashy, and where discipline matters more. And the first lever that shapes that environment is interest rates, of course. Interest rates are like gravity, they pull on everything: stocks, bonds, real estate, even confidence. One big message in the outlooks in the rates have already come down. US interest rates have fallen nearly 200 basis points, about 2 percentage points from their peak. So, what does the market expect next? Markets have been pricing around 2 quarter point cuts, two moves of 25 basis points, as we know, which would bring policy rates close to 3%. Some analysts see a path where rates settle in the 3% to 3.5 area over time. So we have two different scenarios, in my view. If rates drift lower, cash won't feel as magical as it did. Cash may still be safe, of course, but the return you earn on it typically falls when rates fall. That's why this year may quietly push investors to redeploy cash more thoughtfully, because waiting forever for the perfect money moment, is rarely a winning strategy. Another number I'm watching very closely is the 10-year Treasury yield. One outlook expects it to end this year around 4.25 to 4.50%. Think of that as a base temperature for markets. If yields drop far below the range, it usually signals that the economy is weakening sharply. If the yield push above 5%, again, it usually means the bond market is demanding a lot more compensation, and that can create friction for both stocks and bonds. So the base case for this year is not a dramatic rate shock. It's a range bound rate environment where markets go back to what they always return to: earnings, cash flows, and fundamentals, which bring us to equities, of course. I'm focusing on earnings and breadth. When rates are not doing something extreme, stocks usually follow a simple rule: profits matter, always. That's why the forecasters for the new year are so centered on earnings. One outlook puts S&P 500 earnings per share around $300 into this year, roughly 10% growth versus the last year. Another, which is insane. Another view points out that broader expectations are closer to 15% earnings growth. So, yes, earnings growth is still the story. Valuations are already high. We always make all of this analysis into Macro Mornings Pro. When prices already reflect a lot of good news, the market becomes less forgiving. In plain language, this year a company can just sound good. It has to deliver something else. That's why a common expectation is a more normal place of gains, mid-single digit returns, and an S&P year-end target about 7,250, more or less. If you are thinking that sounds less exciting than the last year, you are definitely right. But believe me, it's also healthier. Slow and steady compounding is how most wealth is built, not through constant fireworks as well. Now, the biggest emotional debate in most portfolios out there is mega cap tech and artificial intelligence. A small group of mega cap tech names dominated returns in recent years. One comparison shows the Magnificent Seven rising around 325% over roughly 3 years, while the broader S&P 500 gained around 80%. Over the same stretch, small caps were closer to 40%, Europe around more or less 50%, and Japan 95%. Those numbers explain why so many portfolios became concentrated. Concentration can feel safe in the good times and very fragile when the story changes. So, my plan for this new year is not avoid tech, it's don't depend only on tech. Several outlooks out there hint that earnings leadership may broaden, meaning more sectors can contribute. That's good news for diversification. I still see AI as a long-term force, but at the same time, I'm really more realistic. The first phase of any big team rewards the obvious winners. The next phase often rewards the ecosystem. Some outlooks highlight areas tied to the build out, things like cybersecurity, industrial, and electrical equipment, and data center related investment. So you don't need to memorize all of those categories. Just keep the big idea. The AI story might spread out into this year. And when a story is spread out, you can build exposure with less concentration risk. Now, if equity returns are expected to be positive but more modest, the question becomes, where can you find stability and income? That's where bonds come in. A few years ago, people joked that bonds were dead. Into this year, bonds looks instead useful again, because income is a real again. One outlook points to investment grade corporate bond yields around 4.80%. Over the last decade, that market average uh, just value around 3.82%. I love how simple that is. For years, investors took extra risk because there was no yield. Now, earnings close to 5% from higher quality bonds can be a legitimate part of a long-term plan. And bonds don't just pay income, they can also help you manage emotions. If you ever watched stocks fall 10% in a month and felt your stomach tighten, you understand what I mean. A solid bond allocation can reduce the urge to panic sell because your portfolio is not all mood all the time. There is also a basic concept that easy to visualize. Many bonds are issued around a par value, often $100, as you know. As a bond gets closer to maturity, prices often drift toward the par value, especially when the issuer is strong and there are no surprises. That tendency plus the interest you receive can create a smoother return path. So, if this year is a year of calmer equity returns, bonds may quietly do more heavy lifting than investor expects. Now, let's talk about two supporting actors that can make a portfolio more resilient, in my view, commodities and international markets. I don't use commodities to be clever. I use them to be less fragile. Commodities had a strong last year with about 90% total return, driven mainly by precious and industrial metals. Will that repeat? No one knows, of course, and we don't have any crystal balls as others. But commodities matter because they don't always behave like stocks and bonds. In certain environments, especially when inflation or geopolitics matters, commodities can move differently. And that difference is what diversification is for. For example, oil expectations are a good example of how grounded some forecasters are. One outlook expects oil prices to hover around $55 to $60 per barrel over the next 12 months. That suggests the base case is not a runaway spike, it is a range. And when the base case is a range, I am less interested in dramatic predictions and more interest in balance. And international markets are similar. For a long time, global diversification felt disappointing because US stocks has dominated. But this year could be friendlier to international exposure, especially if US growth stays steady and the dollar doesn't surge higher. In that kind of environment, foreign returns can look more competitive and currency moves can become less of a headwind. I'm not saying to leave the US. I'm saying if your portfolio became accidentally US only because that's what worked, this year is a sensible time to think wider again. So let me end this episode with the simplest truth I know about investing. Most people don't lose money because they lack information. They lose money because their emotions jack their decisions. So I'm using this year as a year to practice something different. When I see the last year deliver 18% total returns for the S&P and 7 more or less percent for bonds, I always remind myself that was strong and I shouldn't demand that every year's looks like that. When I see rates already down about 2 percentage points from their peak and markets pricing 2 quarter point cuts toward 3%, I remind myself cash may not stay king forever. When I see, on the other hand, expectations like a 4.25, 4.50% 10-year yield range and 5% as a watch level, I just remind myself the best case is not the panic, it's the normality. And when I see finally the earnings expectations like $300 EPS, earning per share, and 10% growth, I always remind myself fundamentals still matters more than headlines. And if this kind of macro storytelling speaks to you guys, you will love definitely my newsletter Macro Mornings. It's read by over 53,000 global investors each week. People who want more than noise, they want clarity, insights, and strategy. So it's completely free. You can find the link in the description to subscribe today and join us because if you can do that, if you can stay disciplined, you don't need to predict every twist. You just need to keep compounding. Thank you very much. I wish you a great day. Bye bye.